Hi and welcome to the 7 key numbers that drive profit and cash flow. I'm Chanel Hill of CAD Partners, CFO on Call. Thanks for all of you who are joining us for today's webinar, in which we'll explore how to improve profit and cash flow in your business with the 7 key numbers. We're going to be giving you practical tips which you can implement, and we have guest speakers who are going to be imparting this information to you. But before I introduce them, I want to give you an overview of what is going to happen over the next 60 minutes. Today's agenda is, I want to just start by showing you what today's session is all about and how it came about. So if you're struggling with profitability and cash flow, it could be stopping your business from growing, or worse still, it could be sending you broke. So today we will uncover the key areas that can cause problems with profit and cash flow. A little later after the presentation, you're going to have the opportunity to have your business questions answered by our panel. So I know some of you are new to our webinar environment, and I want to show you how to ask the questions. We're using GoToWebinar as our platform today, and you'll see a panel on the right side of your screen. So one of the areas of the panel is in the questions area. You can type your question into the field and then just hit send, and then we'll get that question. So if it's a technical problem, like you can't hear, or some glitch in your system, I'll answer that straight away if I can. And if it's our panel, if it's for our panel, we'll answer as many of these questions as possible during this session. So just a few words about CFO on Call. We're a group of highly experienced commercial accountants. We help thousands of businesses just like yours with financial management, operational strategy, reporting, training and more. We take an operations view of your business, finding ways to improve your cash flow and bottom line. So today we're really lucky. We've got two fantastic partners who are going to do the presentation today. There's Ashley Arnott and Darren Riding. Ashley comes to CFO with a huge amount of knowledge obtained from such industries as the environmental sector, biotechnology and life sciences, automotive, cosmetics, building and engineering services, as well as manufacturing, distribution, wholesale and retail. And Darren comes to us with broad accounting and finance experience that's been gained from an extensive range of industry sectors, including retail, automotive, franchising, property, hospitality, not-for-profit and service. So without further ado, I will hand you across to Ashley and Darren to continue with this presentation. And I've just made you the presenters, so it's all over to you. Thanks, Ashley and Darren.
Thanks, Chanel. Welcome everybody to today's seminar or webinar. As Chanel mentioned, we're going to talk about the 7 key numbers that drive your profit and your cash flow. I'm going to talk about this first slide here. Shows the typical reports that you would get out of a typical accounting system. One being the profit and loss statement and one being the balance sheet. Now these are sort of the end result of what you do in your business, but just looking at them on their own, it's difficult to work out what actually drives these numbers, and that's what we're going to talk about today. So typically you might look at the cash that's sitting in your balance sheet, but how that cash got there, to find that out you really need to delve a lot deeper. So we're going to talk about that. And we're going to look at those 7 key numbers in a lot more detail. Those 7 key numbers are on the screen here. The first 4 of these numbers are typically found in your profit and loss statement, whereas the final 3 are found in the balance sheet. What they are, the first one is revenue growth, price change, cost of goods sold, and overheads. And these are all measured on a percentage basis. And the next 3 are accounts receivable days, days payable, and your days inventory or work in progress. And these are generally measured in days. Why percentages and days? Basically because it's all relative. So in absolute terms, it doesn't give you a true picture. going on. You need to look at your percentages and your days. Okay, let's have a look at a typical business. This business here, it's a bit of a case study. It's got a turnover about $1 million, and you can see here just by looking at tweaking a few of these 7 key drivers how it can make a dramatic improvement into the overall result. So looking at sales or revenue growth, just say for this example it remains steady. So no extra cash is derived from that. A small price change, so let's increase prices by 2%. In this example, that'll give you an $18,000 increase. A small reduction to cost of goods sold, decrease it by 1%, that gives you a further $10,000. It's another small reduction in overheads. Typically 6% might sound like a lot, but it's really not when you're talking overheads where big gains can be had. That gives you an extra $20,000. Improved accounts collections, reducing that by 11 days. We'll put another $32,000 in cash in your bank, and reducing your inventory work in progress by another 10 days will give you another $20,000. So you can see here a few changes to the key numbers can give you a big impact into your profitability and your cash. Cash is king. We've all heard it. It's been said a number of times on pretty much every show that goes around talking about finance. Sure, it's king, but the key question we've got to ask is, where is it? And cash isn't just what's in your bank. When you're thinking about cash, you've got to look at the other factors. And what it is, cash is in your suppliers when you pay them. Cash is sitting on your stockroom shelves. Cash is sitting in work in progress, in any unfinished jobs you've got going on. It's sitting with your customers who haven't paid you yet. It's in the assets that you've purchased rather than hiring or leasing those assets. And what we're going to do today is help you look at how to get that cash out of those areas and into your bank account. So let's have a look at the cash flow cycle. So a typical cash flow cycle, let's say we buy stock or we buy materials for jobs we need to do on day one. If you have credit terms with your suppliers, maybe 30-day terms, so that means you're going to have to pay for those materials or pay for that stock or pay for that labour on day 31. Let's say we sell the stock or we perform that job. It takes us 30 days to do so. So on day 60, we actually sell that product. And what that means is that you've got 30 days of negative cash flow. So a lot of businesses out there, they don't run on cash. They offer terms to their customers. 30-day terms generally stretch out to 60. So let's say 60-day terms or 60 days until you get paid. What that is, that's another 60 days of negative cash flow. That's 60 days where the money is not in your bank account. Add that together, that's 90 days of negative cash flow. That's 90 days where you're funding someone else's business. Okay, how a business can be growing broke. And growing broke's a pretty, and that can be very realistic with a lot of companies. They think that the more profit, the more sales that they make, the better they're going to be. But it's actually not quite the case. So we've just had a look there at what happens when we make a sale and we extend terms to customers, and we've got to fund 90 days, potentially 90 days of credit for every sale that we make, and that's where a lot of businesses get into cash flow difficulties, because they don't understand that the more sales you make means the more cash you've got to have, or the more working capital you've got to have in your business. So where is that cash going to come from? Well, if your business is going to grow, funds must be in place to cope with that growth. It can come from borrowings, it can come from cash injection from business owners, from sale of shares in the business, etc., etc. But cash can be improved with good management of these key drivers we're going to talk about. So let's have a look at them now. The first one is revenue growth. This is a percentage by which revenue has grown from one period over the next, as per the calculation on the screen. The calculations are in a free ebook that will be sent to you after this webinar, so don't be too worried if you don't get a chance to write all these calculations down. So this example shows that revenue this year is 1.5 million. Revenue last year was $1 million. So you divide that million by 1.5 times it by 100 and you get 50%. So it's 50% growth in this current year. So the impact of that, as we just discussed, how growth creates a need for more cash. And this is important to understand and to plan for. We had one client recently that had an opportunity to buy out a competitor for $600,000, and it seemed like a good idea at the time. But when we did some work and some analysis on that, we calculated that that business would require an extra $250,000 in working capital to be able to fund the operations of that business. So, and that's something the client hadn't considered. They decided the business really wasn't a bargain that they first thought it was, and didn't go through with it. Had they gone through with it, it probably would have placed a big cash drain on their current business. So that's an example of where you buy your growth, or you buy some new revenue streams into your current business. But the same thing happens with organic growth, and when you create that growth yourself. So increase in sales. Working capital, a lot of the time, when you make a big sale, you've got to consider how you're going to fund that sale to avoid a cash flow squeeze. You can ask a client for a deposit or progress payment. You could borrow funds to cover the cost of the growth, but take care when you do so that the interest that you're paying out through those additional funds doesn't eat into all your profits. You could sell shares in your business to get more cash in. You could lease some currently held assets, such as equipment or property, to get funds in. But and if anyone's got any suggestions on other ways to do it, type them into the panel on your screen now, and we'll share them with others. What we've got on the screen there is profitable growth, or profitable revenue, sorry. And this is what's very important and what's overlooked a lot of the time. When revenue grows, it's important to ensure it's profitable revenue. That is, you need to know the true cost of the product or the service to ensure that the sale will contribute a reasonable level of gross profit to the business. When people make decisions to sell more, a lot of the times they do so without really understanding the true cost of the product, and it's not always just the cost of the material they're making that product. It's all the additional labour that might be involved. It's the additional overheads of the business, so the cost of the business, which isn't directly linked to that sale, but will be affected by making an increase in sales. So you really need to understand your true cost to be able to work out the effect that growth will have. You also need to work out what your most profitable revenue streams are. Do you measure profitability of types of jobs or products? If you don't, you should, because you'll find that a lot of the times businesses have very profitable products or revenue streams, and that can cloud over the unprofitable ones. So you really got to look at it on whether a job-by-job basis or a profit-by-profit basis, a product-by-product basis, to actually understand what your real profitable revenue streams are. And how to do this? Well, rather than lumping revenue all into the one account in your books, try to split it up into your different products or your different job groups, so you can see on a regular basis what are your most profitable or your least profitable areas of the business. And you also need to split the costs relative to these groups so you can measure it against the revenue and see your real profit that it's making. So what about costs? Well, often costs can be your key area of control. Market forces and competition may dictate what the price that you may have to sell your products or your service for. So So price isn't always something you can set, but cost is something that you can change. You can find things from cheaper ways of funding things, of finding things. Look at your different suppliers and different ways you may put those costs together in your business. There may be more effective ways to manage those costs, and we'll look at costs a little bit more detail very shortly. So our second one is price change. Go up there at the top, fear of losing customers. Many small businesses have a fear of losing customers if they increase prices. But you've got to think to yourself, unprofitable customers, are they really worth having? Next one we've got there is selective price increases. When we talk about price increases, it doesn't mean you have to increase all prices across the board. Perhaps the best sellers are you can focus on those ones and try to increase the prices of those ones, and because they're likely to be the items where you'll experience the least customer resistance. For example, we've got a customer who runs a plant nursery, and they hadn't increased prices for quite a while. They were a bit scared to do so, but we encouraged them to do so. And what they did, they went through and had a look at their top 10 or 15 sellers, or their best sellers, and they increased prices by, not a massive amount, but not an insignificant amount as well. And they did so. They found they had absolutely no resistance from customers, and doing something like a price change, that money the increase there that you get, or the additional funds that you receive from increasing prices, it goes straight to the bottom line, because it doesn't have any costs associated with it. Value improvement is a great way to justify a price increase. A lot of times you perceive that a product or service that you sell has value, but the customer doesn't necessarily have the same perception. So make the invisible visible. Let the customer know, and do some work to actually promote the value that you offer. Let customers know how and why you deliver a great product or a service. They may not know, and they probably don't know if you don't tell them. Connect price increases with cost increases. So regularly measure your gross margin so you know when it's time to increase prices, because your costs are going up always. So every 6-month period, every 12-month period, you don't increase your prices when the costs of your business are going up. It's going to impact on your gross margin, your profit, and therefore your cash. A good way is to include price increases into contracts with your customers, so they won't be surprised when it actually does happen. Okay, next point we've got there is price versus volume increase, and that's explained a little bit more in the table below. And what that's the point of this table is to sort of highlight to you that a small increase in price can have a bigger impact on your bottom line than a large increase in volume, because the price increase goes straight to your bottom line, whereas the volume carries a lot of extra costs with it, and also quite often some additional overhead costs as well. So in the table you can see that a small 3% price increase can improve profit by $30,000, or 3%, whereas a volume increase of say 5%, and in this case even if the overheads are unchanged, would require you to achieve, a 5% increase in volume would be required to have that same effect on your net profit. And if overheads increase by a little bit along the way, which quite often they would, that volume increase of 5%, could be 6 or 7%. So, and this is assuming that your cost of sales is only 40%, which is quite a healthy gross profit. So a lot of businesses, their margins or their gross profit is a lot less than 60%. If it was maybe only 20%, then you'd find that volume increase would need to be a lot more than that 5% to maintain the same profitability as your price increase of 3%. Discounting. A lot of people talk about discounting, whether you should discount, whether you shouldn't. So before you discount, it's a good idea to know how much more volume you'll need to sell to get the same profit. And it's a little bit along the same lines of a negative price increase. So if you put your prices down by 3%, you're going to have to sell at a lot of the time a lot more than that 5% increase in volume. It's not just putting your price down by 3% and hoping that your volume will go up by 3% to maintain the same amount of profit. A lot of times, you drop prices by 3%, you might have to sell 20% more to cover that. So that's where it's really important to understand what your cost of sales are and your gross profit margin to understand the effect that a discount will have. It's not to say that you shouldn't discount, and a lot of businesses out there add a discount into the price. So they might, you'll see companies like, your gas company or your phone company say that if you pay on time when the bill's due, then you get 3% off the price. Well, what they've done effectively is added that 3% already into your price. So you're sure you get it cheaper by actually paying on time, but their actually margin's not going down because they expect you to pay on time with that little bit of incentive, which, it's a good incentive, 3% incentive to pay on time. It's actually quite worthwhile doing. So you can do that too in your business. You can offer a discount to pay on time, but you've got to do so having full understanding of what your costs are, and if it's going to affect you too much, when you establish your prices for the year, build that into the price. So knowing that you're going to put a discount in place, build that additional 3% into your upfront price with the customer. Overheads. So you still need to cover your overheads. You've got to make sure when you set prices that it's going to cover your overheads, because a price increase goes straight onto the bottom line and discount comes straight off the bottom line. Whatever way you do it, you're still going to have overheads to cover. And just one final point on price change. There's a danger of never increasing prices, and that is that your margin is constantly going to be going down because your costs are always going to go up. As I mentioned earlier, you have to find a way in your business to maintain your gross margin somehow in order to cover all these overheads, because the longer you leave it, that margin squeeze is going to become more and more crucial into your business. The next point we've got is cost of goods sold, or cost of goods sold percent. Okay, measurement. Cost of goods sold percentage is the measurement of your cost of goods sold compared to your revenue, calculated as per the example we've got on the screen. This shows revenue of $1 million, cost of goods sold of $400,000. So you divide your cost of goods sold of $400,000 by a revenue of $1 million, and then multiply that by 100 to arrive at your 40%. Now, your cost of goods sold, as I just talked about before, is the number one thing that affects one of the two main things that affects your gross margin, which is your revenue less your cost of goods sold. Management and procurement. So bigger businesses tend to put a lot of resources into calculating and monitoring this. Small businesses often don't have the resources, as the business owner is often too busy selling or doing everything else. And what we mean by procurement? Well, what it means is to acquire something with care. And this is a key area and probably the most sensitive driver of all, because a very small decrease in your cost of goods sold percent can have a very big impact on your profit. And it's really worth having the resources to manage this area. So how can it be done? All right, we've got 4 points there to work out how it can be done, or to explain how it can be done better. First one is responsibility. Someone needs to have it on their job description and be trained in procurement. If you don't, find someone it's their role. Often in businesses it's left to 3 or 4 different people to buy things, but no one really takes responsibility or ownership of it. One of the key things to be able to control it is for one person to take responsibility for it. Doesn't mean that that's the only person that does it, but it should be one person who is responsible. Second one is suppliers. If you buy a lot of products or services from a supplier or different suppliers, you could tender out for your business. Again, it's something that larger companies do and smaller companies do less so. And it's very worthwhile because it creates a competitive environment with your suppliers. As a business owner spending a few days looking closely at your costs, you could pay big dividends in your bottom line. Next one is alternatives. So do a little bit of investigation on new methods of supplies in your industry, and think laterally about how you do things. Try to come up with a bit of a win-win situation with different suppliers or new suppliers, because if you think about it, the more business that you have, the more business you're going to pass on to your suppliers. So it's a lot of times trying to find that win-win position with your current supplier or an alternative supplier is really good and really beneficial to both businesses. The last one we've got there is purchase orders. And purchase orders, really what it is, it's a control document to avoid unnecessary spending by staff. And what happens is if staff have to complete a purchase order for something, and purchase orders are things that it's a control document which needs to be approved before you actually go out and buy something. So there's a couple of reasons why purchase orders are good. One being it needs to be authorised by someone else before you actually spend the money. A lot of times once the money's been spent, it's too hard to get a refund or it's too hard to give it back. So if that person hasn't got proper approval to spend that money and they've already spent it, it's very hard to get that back. So the horse is already bolted, so it prevents that. The second one is that by having it authorised by another person, that other person is generally someone of authority, and generally they may know something that the person placing the order doesn't know. So it could be that they may know of some place to get it cheaper, or they may know that it doesn't really be needed that much, or that much of that product doesn't need to be purchased at that time. So little things like that can often save you thousands of dollars over the course of a year. And the fourth one of these items that relate to the profit and loss statement is your overheads percent. Overheads percentage is a measurement of overheads compared to revenue as calculated by the example on the screen. So overheads are slightly different to cost of goods sold as they occur all the time, whether you sell something or not. For example, you've got rent, occupancy charges, you might have wages and salaries in relation to your admin area. Could be things even like your telephone bill, you might be on certain plans, so things like that are generally fairly stable from month to month. They may go up and down slightly depending on the level of sales activity, but generally they won't move too much. So again, procurement and responsibility is important, just like it is with your cost of goods sold. It needs to be managed, and someone needs to be responsible who understands the importance of keeping overheads down. A budget's a great way to start, so it's a great start to keeping your overheads down. Take some time at the start of every year to plan your overheads and enter it into your accounting system or your accounting software even better, because that'll then give you a bit of encouragement to actually print out some reports and compare your actual versus budget. And having a budget really is, it's a control document that every business should have. Okay, review regularly. So regular reviews with overheads, more so than a lot of parts of your business, is crucial. I say that because overheads are generally something that don't get reviewed too often. It can go. A lot of businesses can go for years and years without actually reviewing their overheads, and it might be you're on a mobile phone plan that you took out 4 years ago, where half an hour to review what different plans are out there at the moment could save you thousands and thousands of dollars, because things always changing. And by reviewing your overheads, you need to look at what's really crucial in your business and what's not. And I don't mean by that to just go out and slash and burn your overheads, because you need to be able to maintain your business levels and justify those. And justify what you need to be able to justify is that your overhead expenditure is going to be enough to actually generate the sales that you need. So you can't go in and just slash and burn your overheads and think that's going to create more profit, because what happens with some businesses is they do that thinking that they're going to cut all these costs out of the business and therefore they're going to make more profit. But a lot of times that has an effect on the amount of things that you can sell and service your customers. So it actually can have a negative effect by slashing and burn your overheads, and often does. So it just means going in and having a good review on your overheads and making sure that everything you've got in there is actually realistic, is actually required in your business. And again, get the supplier to tender and compete for your business. But while you might have a budget, never tell them what your budget is. Printing your profit and loss with percent. I've got that there because that's a really good way of over time developing a better understanding of your overheads and how they contribute to your profit. You can select this type of report in most accounting systems, and it enables you to keep track of how your overheads are going and compared to your revenue more easily. Again, use purchase orders similar to the cost of goods sold. I don't mean purchase orders for every little bit of overhead that you might have, but set something up in your business so that it might be, say, for everything over $100 that is spent, you need to have a purchase order approved before it's spent. And again, that's something that could save you thousands of dollars over time. Okay, I'm just going to hand you over to Darren now, and he's going to go through the five other factors, or the three other factors that affect your cash and your profitability.
Okay, accounts receivable. Accounts receivable days is the number of days on average the customer's taking to pay if you give them terms. In the example there, we can see that with accounts receivable of 150,000 and revenue of 1 million, divide the 150,000 by 1 million and then multiply it by 365 days to arrive at 55 days. This often varies greatly from the actual terms offered by customers. So what we need to do is to have a good system for collecting. In terms of the responsibility, we need all aspects of accounts receivable to be in someone's job description, which is not just sending out invoices. They need to regularly report on the results so you can see trends and improve on them. Now, the terms begin with the customer's understanding of your terms. Document and get customer agreement to them at the sales point. Take care who you offer credit to. Do credit checks first. Use companies like Credit Watch. Don't give away extra days credit on top of the terms that you offer. Do progress invoicing if appropriate and promptly. Make it easy to pay you. Offer credit card, PayPal, internet banking, BPay, or anything that makes it easier for customers. Send statements by email religiously and add notes to them in your email to show that you're on top of things. Call up people who owe large amounts of money and keep good records of conversations. Make arrangements for amounts to be paid off over a period. The sooner they start, the sooner it will get paid off. Put late payers on CAD until the debt is paid off. Send reminders when a large bill is due beforehand so they can't forget to pay. And utilise debt collectors as they can be successful and some only charge if they are. Accounts payable. Accounts payable days is the number of days on average that you're taking to pay your suppliers if they give terms. In the example there, we can see with accounts payable of $50,000 and cost of goods of $400,000, You divide the 50,000 by 400,000 and multiply it by 365 to arrive at 45 days. This is the flip side of accounts receivable days, where you want to minimise them. With accounts payable, you want to maximise them. You don't want to string out suppliers to the point where service or supply suffers, but you want to negotiate the best terms possible. Don't pay all your suppliers on the same day. Pay them on the due date and all the credit you're entitled to. Don't have an efficient payable person and an inefficient collections person. Have them understand the correlation between the two and your overall objective to improve cash flow. Regularly measuring the number of days and work it on lengthening it. Negotiate the best terms possible. Don't assume you have to pay COD, ask for an account. Don't pay early without getting a discount. Negotiate and seek better terms if you're a good customer. And regularly review all your suppliers and seek alternatives if current suppliers won't negotiate on terms. Work in progress and inventory. This is the number of days on average that your inventory sits in the store waiting to be sold. In the example there, we can see that inventory at $50,000 and cost of goods at $400,000. You divide the $50,000 by $400,000 and multiply by 365 to arrive at 46 days. That's 46 days inventory you've got sitting on your shelves. Have a good system for managing your stock. There are some great low-cost ones available today. Ensure one person does all the buying to avoid over-ordering or obsolete stock. Report on what's moving and what isn't. Regularly review inventory days, the calculation that we just did there, and work on reducing it. Analyse sales patterns and make or order only what you need. Think of stock as dollar bills piled up on the stockroom floor. You don't want it to be there too long. Also consider seasonality. Purchase orders, we've already mentioned that they're a great way to avoid over-ordering and obsolete stock. And with obsolete stock, find innovative ways to get rid of it. We had one client in the rag trade in a regional area who needed cash, so they rented a church hall in the city, piled all their obsolete stock into a van, sent out a message via social media to the Generation Y customers, and came back after the weekend with $40,000 in cash. So your days inventory of work in progress, the number of days on average that jobs are in progress waiting to be invoiced. Now, in the example there we can see work in progress of $80,000, cost of goods of $700,000. We divide the $80,000 by $700,000, again multiply by 365 to arrive at 42 days. Again, that's money tied up in work in progress for 42 days. There's some excellent systems available for keeping track of jobs, including quotes, scheduling, tracking materials, and time on jobs. Have a good system, and it makes it easier for someone other than the business owner to do everything. Checklists can be set up to avoid having to reinvent the wheel all the time. Regularly review work in progress days and work on reducing them. Think of work in progress as dollar bills piled up on the workroom floor. Review staff productivity. How many hours were productive staff spending on unbillable tasks? Multiply this by the charge-out rate to see how much you could be losing. Quoting is vital to ensure you're making a profit on jobs. A good system enables you to measure against the actual quote-based profits, and it'll help you improve in this area. Quote versus actual is a great way to ensure you've got your quoting right and see what went wrong when you're giving it so you can avoid it next time. Job track record. If a client rings up and says he wants you to repeat a previous job. A good system enables you to access information, saving time and quoting on delivering. Job profitability, a good system will enable you to review a job profitability easily over all jobs, types of jobs, individual jobs, and see where and why you lost and made money. You'll know when it's right to increase the price when your average margin slips on jobs. If you have a reporting function in place, this will also assist you. It'll help you see when material costs are increasing and when to increase your costs accordingly to maintain your margin.
Okay, so just to recap, the result of improving all these numbers, they're there on the screen, but so just to recap what those 7 key numbers are. You've got the first 4 ones which you find in your profit and loss statement, being your revenue, your price, your cost of goods sold, and your overheads. And the best way to measure these is through percentages. And these are the 4 things that you need to work on to improve your profits. The final 3, or 3/4, are accounts receivable, accounts payable, your inventory, or your work or your work in progress, depending on your industry. And those 3 items are all found in your balance sheet. The best way to measure those are in days, and what those 3 those 3 things really do is help you to turn your profits into your cash in the most efficient and quickest way possible. So the result of improving all these numbers, I've got sustainable business. What that means is you can sleep easier at night and your staff feel more secure. Ability to grow and get growth funding. Good cash flow gives you confidence to do that. Less stress gives you time to think more creatively about your business growth and innovation. Now, I've seen it many times in businesses that they run into cash flow difficulties and they spend so much of their time worrying about how they're going to pay their bills or getting the customer to pay that they don't have any time to actually think about the things they should be thinking about, is business growth and how to continually evolve. Less interest. Obviously, better cash flow management reduces the borrowings and the interest you have to pay thereof. Business owner and staff satisfaction means less staff turnover. You've got more time and more money that you've saved that you can spend on training new people. Obviously, better profits. So managing these 7 key numbers and percentages will improve your profits. Better business value. What we mean by that is, as a result of a better profit, the value in your business, which is often calculated by a multiple of your profit, will add up. So if you're looking at selling your business at some stage, and generally everyone's in business to one day get out of business, then the more profits and the better systematised you become with these 7 key numbers ultimately means the better business value you're going to have. And last one there, more time for yourself. So less time fighting fires equals more time for yourself and a better lifestyle for you and your family. Okay, I'll just hand it back there to Chanel so she can wrap up today's presentation.
Well, thank you, Ashley and Darren. That was fantastic. So it was a great explanation of the key drivers. And so our partners, we'll just have a look at the questions, or there haven't been any today, which has been good, but if you have any questions that you would like to ask Darren and Ashley, please feel free to type them into that pane that I spoke to you about earlier on, and then we'll answer them. So yeah, we have access to some great tools and methods for improving these key drivers, and our partners will be happy to chat to you about them. So our offer to you today is basically find out how much profit and cash flow improvement could be achieved in your business. we provide a free 1-hour consultation with Darren to discuss your cash flow bottlenecks and how they can be improved, how the profitability can be improved, how systems could also improve your efficiency, your stock management, your job management, invoicing and collections, and if pricing and costing also needs review, the growth viability and funding requirements. So to get a free 1-hour consultation with Darren, just call Laurie Meekins on 1300 36 24 36 to arrange a mutually convenient time to meet with Darren. So what to do next is to call Laurie and also ask for a free copy of our book, The 7 Key Numbers That Drive Profit and Cash Flow. It's a great book that Sue Hurst and Stuart Frost have written, and it explains exactly what Darren and Ashley have been talking about today. So, so at the end of this, it's been lovely to have you with us. I hope you've got a lot out of it. I'm sure you have, because Darren and Ashley have explained the 7 key drivers so beautifully, and I hope it helps you with your improving your business techniques and systems. And as I said, please call Laurie on 1300 36 24 36 and arrange a free 1-hour consultation with Darren, and he can help you look for new ways to improve your business as well. So thank you so much for joining us today. Thank you, Ashley and Darren. It's been great, and you know, just to hear your knowledge as well. So thank you, everybody. Okay, thank you. Goodbye.